1 year ago, Rachel Reeves and her then Shadow City Minister Tudip Sadiq were prowling the streets of the city on what had been jokingly dubbed the scrambled egg and smoked salmon offensive in the square mile. They were looking to charm executives over breakfast, put forward a more pro-business, pro-commerce version of Labour and reset the party's relationship with the private sector after a fractious few years under Jeremy Corbyn. And it was, for all intents and purposes, a resounding success. The party won the backing of scores of senior leaders and city types. Labour's business events were stacked full of movers and shakers, and the party pledged to treat the city and business as an engine of the economy rather than a cash cow to be squeezed for taxes. That mood, however, has soured somewhat over the past few weeks, as Reeves now gears up for her first budget as Chancellor on the 30th of October. Fear and loathing are gripping the city and nervousness has taken hold. And while the government did wrestle back some control of that narrative with a splashy investment summit, commitments of billions of pounds from global investors, questions are still hanging in the air over its tax plans. Investors and executives around the country are now fearful of a punishing tax squeeze on the city at the budget at the end of this month. But are they right to be scared? I'm Charlie Conchie, Chief City Reporter at City AM, back with another episode and a new series of Bonds and Ballots, where we'll be asking, is business scared of Rachel Reeves and why? The mood among city bosses and investors has been pretty fractious over the past few weeks. While Rachel Reeves has committed to ruling out a hike in corporation tax for the duration of this parliament, there are a few measures still on the table that are spooking the city and businesses. Three particular taxes do appear to be the primary concern for companies. One is a lift in capital gains tax, which is the charge paid when selling an asset that has increased in value. The current rate of capital gains tax sits at 20% for top rate taxpayers on all assets outside of residential property. Investment fund managers, meanwhile, pay 28% on the personal profits they make from the sale of assets, so-called carried interest. The government has already confirmed it will lift the charge paid by fund managers from its current rate of 28%. This could be pushed to between 30 and 40%. On other areas like shares and non-residential property, however, it's unclear what the government's plans currently are. There are fears that the Treasury could dramatically push up the rate of capital gains tax and damage investors' appetite for holding assets like shares, with the knock-on effect of that being that entrepreneurs and investors no longer have the same incentive to operate and invest in the UK. This also comes as the Treasury is reportedly mulling plans to remove an inheritance tax break on London's junior stock market AIM. That tax break has been one of the big incentives to invest in the smaller, unlisted and riskier companies on the AIM market, and it allows shares in those companies to be passed over after death free from inheritance tax. By removing it, there are fears that as much as £6 billion could be sucked out of the market and stocks could dive as much as 30%. All this after 15 years in which the number of companies listed on AIM have plummeted and money has been sucked out of funds investing in that particular market. Rounding off that trio of big concerns for business is a potential rise in national insurance contributions for employers. Labour campaigned on a pledge not to hike national insurance contributions, but they say they meant for employees or working people, as they put it. For companies, however, that door has been left well and truly ajar. That would most likely come in the form of national insurance contributions on the money that businesses pay into staff pension pots and might raise around £17 billion for the Treasury's coffers. But it is yet another bill on the list for business. The prospect of those tax plans has spooked business in the run-up to the budget. But is this all threat without substance? Should business and the City of London actually be as concerned as some of those loud warnings suggest? I've gone to ask Callum Pickering, Chief Economist at Peel Hunt, for his thoughts.
Is the city nervous about the budget? Yes, there's a sense of foreboding. The problem that we've had is we've just had a long time to speculate since the election right up to this date, and if you're left too long to think, well, you start worrying about the worst. There are some specific areas where I think the market should be concerned. How government might treat capital gains tax, whether or not they'll remove inheritance tax relief. This could hurt specific parts of the market. But broadly speaking, we know a lot of what's in the budget. We know the government won't raise corporation taxes, it won't raise income taxes or national insurance, or change VAT. That's more than 70% of the tax base. A lot has already been signalled on spending, including the potential to increase investment through a little borrowing. And so what I think we're facing is a bit of an event horizon risk, which probably is somewhat overblown. With Brexit, with the EU negotiations, with some of the elections that we've had, it paid to just wait to see what kind of world you're in. But I don't think this budget presents such a serious economic risk that you should be holding off investment in the UK writ large.
That pressure from the business community points to the unenviable tightrope that the government has to tread. Try to create a world-leading business environment on the one hand, while filling what Rachel Reeves has called a £22 billion black hole in the public finances. Alongside that, there's a package of city reform that includes everything from unleashing a wave of cash from the city's pension funds, stripping back unnecessary regulation and tempting more companies onto London's markets. But is balancing the two actually possible? And crucially, has business lost confidence that Labour is on its side?
Well, certainly I was at the Labour Party conference listening to Rachel Reeves' speech this time last year, and you could hardly move. Many people couldn't even get into the room, so much so there were so many business leaders trying to hear her speech. Then, of course, we have the election, and there has been a bit of a vacuum. There has been a bit of criticism, understandable in many ways, that really the Chancellor's waited too long to deliver the budget, because between the election and the budget, there's just been a lot of speculation swirling. And if you look at the business surveys, particularly those that have come out in September, they do show that business confidence has been dented. However, this may end up being temporary. Once we do finally have a grasp of what the playing field is going to be looking like post October the 30th, that will reassure businesses, I think, to some extent, and provide some more certainty, because that's what they haven't got at the moment. And of course, we know businesses don't like uncertainty. It's very difficult to operate in that environment.
Hargreaves Lansdown is obviously a business that is going to be very much affected and impacted by what is in the budget. A huge base of retail investors in the UK, biggest in the UK. What would Hargreaves Lansdown as a company like to see there to fuel some investment, get people back into the stock market?
Well, it's really great to see the National Wealth Fund being established to try and draw in more investment into the UK. But let's not forget the power of the retail investor, largely untapped. Because we're enthusiastic holders of UK equities. When retail investors do invest, 75% of the trades carried out on the HL platform are in the London market. And so that is offering real capital for UK-based businesses to grow and help achieve the growth that Rachel Reeves and Keir Starmer is talking about. But to do that, they need to be incentivised. So there's a lot of talk about increasing capital gains tax, for example. That's not necessarily going to be an incentive for people who are investing outside of their tax wrappers. So we'd like to see the CGT allowances raised. They've not been this low since the early 1980s. Also, stamp duty, why should those retail investors be penalised for trading in UK-based shares when they're not if they trade in overseas companies as well? So let's try and look at ways to incentivise this army of retail investors who really could boost the UK's growth by getting involved in the stock market and at the same time building their financial resilience.
It is a tricky cocktail of pressures now facing Rachel Reeves and Keir Starmer as they approach their first budget in government. They, on the one hand, say they've been left with a £22 billion black hole in the public finances, and business, on the other, is fearful that it is now going to be the target of a punishing tax raid. Whether those fears are founded, however, we'll just have to wait and see. Let us know what you think in the comments below. Should business be worried as we approach Labour's first budget in government?